Recording is in progress. That's good to know. I think you already know the team here, but I'm very pleased to introduce you to Ian Hancock, who's somewhere along the top of your screen, probably. Ian is our COO, and I think probably most of you know Tracy Lawrence, our practice manager, as well. We're also delighted to be welcoming back our guest speaker, Anthony Willis. Anthony is senior economist at Columbia Threadneedle, and he's here to give us some valuable insights into what's happening in our economy and the things we need to be aware of this year. So we've got an action-packed agenda. We're recording the session because several of our clients are on cruise boats at the moment and sitting on beaches, and for some reason decided not to tune into the live version of our presentation. Everybody should be on mute during the presentation. And I'm just going to go through the agenda now. We're firstly going to be taking a quick look at the spring budget and considering how this fits in with changes announced previously. Then we're going to be welcoming Ian and Anthony, who will be in conversation regarding the markets and the economy. After this, Ian is going to be giving us some insights into what goes on behind the scenes here when it comes to operating our investment steering committee. And we'll close with a run through of the key takeaways and action points, and hopefully the session will last 40 to 45 minutes. We do have a chat facility, which you'll see at the bottom of your screen. So if you would like to ask a question, then please feel free to put it in there. I don't think we're going to have the opportunity to answer questions during the presentation, but if you do ask a question, we'll get back to you. So over the next few minutes, I want to take a quick look at the recent spring statement and how this fits in to what's already changed following previous budgets. And most importantly, what this means to you and your family's long-term planning. But looking at the big picture, the direction of travel, if we were to summarise government policy in one sentence, I think it would be this. The tax system is gradually becoming less generous for savers, investors, and wealth holders, largely through frozen allowances rather than headline tax rises. The spring statement in itself didn't introduce any major new tax measures, as the Chancellor has already committed to only one main fiscal event each year, but instead it confirmed the economic outlook and reinforced the policies already announced in previous autumn budget statements, both last autumn and the autumn before. So I think the key takeaway here is continuity, not massive surprises. So when thinking about where the UK stands from an economic perspective, Anthony's obviously going to be covering this in more detail in a few minutes, but I think the government's latest forecasts show that growth is modest, inflation pressures are easing, but the economic environment remains uncertain, particularly due to global energy risks. And for investors and retirees, we feel this really enforces the importance of planning rather than reacting. So the key points from the spring statement, thinking about state pensions, they rise by 4.8%, increasing to about 12,500 per year, or 12,548 per year under the triple lock. This is important because income tax thresholds remain frozen and more pensioners are gradually being pulled into a tax situation. This is known as fiscal drag. And taxes are quietly rising, aren't they? Tax as a share of the economy is projected to reach record levels by the end of the decade, largely due to those frozen allowances rather than explicit tax increases. So the real planning changes from the previous budgets, well, the bigger changes affecting us actually came earlier, as we've said before, and these are now being implemented. They include the frozen income tax and inheritance tax thresholds. We know that IHT is frozen until at least tax year 2030-31, which will represent 20 years of the same threshold there for inheritance tax. And who knows, that could go on beyond 2030-31. We've got the reduced tax advantages of savings and investments, changes bringing pensions into the estate for inheritance tax purposes from next April. And we're going to be just having a look at that in a bit more detail in a minute. We've got falling ISA flexibility over time and increasing taxation of dividends and investment income. So the results are quite simple, really. More families are being subject to inheritance tax, even those who really never expected to be caught by it. Estate values above 2 million are also seeing allowances reduced. If we think about the residence nil rate band, that tapers off from 2 million and is completely gone if the estate value exceeds 2.7 million. And those future pension taxation changes are going to increase exposure to inheritance tax even further. So what does this mean for many of our clients? Well, the planning challenge is no longer all about accumulation, it's effective distribution of wealth. And we're seeing three major themes here. Firstly, inheritance tax is becoming a central planning issue. Secondly, pensions are no longer that automatic pot of money outside of the estate. Fundamentally, legacy planning is changing, and those pension changes are really bringing some significant post-death challenges for both our personal representatives, our executors, as well as the pension providers. And tax planning investment wrappers now matter a lot more than they have done before, perhaps. So just touching on things we've identified in previous briefings, effective structures include investment bonds, trust planning, structured gifting strategies, and whole of life insurance, what we like to call our ultimate savings plan. These are all becoming increasingly important tools for effective planning. We have had handouts at previous webinars. If you'd like some more information about any of those points, then please let me know and we'll send that through to you. So I just want to take a minute to touch on the challenges around pensions no longer being outside the estate for inheritance tax purposes. And as I mentioned in our last webinar, I really believe that there are some huge unintended consequences of implementing this particular change. I had the pleasure of sitting on a STEP webinar last week, obviously making sure that we're keeping well abreast of important changes coming down the line, particularly for our legacy protection clients there. And if you're not familiar with STEP, STEP is the Society of Trust and Estate Practitioners who set out the professional standards for their members, of which I am one, regarding wills and trust writing and advising in that particular area. So the key things I think that we need to keep in mind are that the effect of that new legislation next April are going to mean that all residual pension funds on death, be that pension drawdowns or pensions still in accrual, their values will need to be added to the IHT 400 forms during the early stages of the probate process. Our executors and trustees or our personal representatives are then going to be liable for that tax, which needs to be paid within 6 months of death. Can't get clearance for probate unless that tax is paid. Think about the fact that our nil rate bands are going to need to be shared or apportioned across the whole of our estate, including our pension funds. And what happens if our estate beneficiaries are different from our pension beneficiaries? The pension scheme administrators are going to need to liaise with our personal representatives in order to get all of this sorted. We're going to very quickly need to introduce those two groups of people at the early stages of probate to have any chance of doing anything within the time frames. What happens if a pension pot is missed at the beginning of the probate process? It's going to throw all the inheritance tax calculations out of kilter. There are going to be lots of potentially unintended consequences, we feel, for unmarried couples and dependent pension situations. And I think it brings back into the equation the investment strategy of the pension, thinking about the liquidity. And whilst I don't think we've got any major problems with our Transact pensions, what if a client owns a SIPP and has property within that SIPP and the inheritance tax liability needs to be settled within 6 months of death? Could create enormous delays, could create delays for deed of variation work as well. This is all still subject to parliamentary debate, particularly that issue of the 6 months to inheritance tax payment, because we've got to keep in mind the fact that anything that runs beyond the 6 months is accruing interest at 7.75% currently. which is a huge roll up of interest for the estate and for the personal representatives to have to deal with. So at the moment, all I can see is that greater need for professional probate services is going to be needed more than ever before. So why does planning early matter? Well, one consistent message from these recent budgets is this: time is now one of the most valuable tax reliefs available. And why do we feel that planning early is important? Well, it allows for gifts, whether they're outright gifts to loved ones and beneficiaries or gifts into trust. It gives them more time to fall outside of the estate. It gives more flexibility potentially if legislation changes again. It potentially lowers the long-term costs of planning. Think in terms of the cost of whole of life insurance that only goes in one direction upwards as we get older. And it clearly gives greater certainty for our loved ones and beneficiaries if we've got planning in place in good time. So the focus for planning, I believe, now shifts from simply growing wealth, which we've been doing extremely successfully in Montgomery over the last few years, but more to protecting it and passing it on efficiently. And we're obviously here to help in Montgomery estate planning and legacy protection as we go on. But I think you've heard enough of my voice for a few minutes, and I'm pleased to hand over to Ian and Anthony. Ian, over to you.
Thank you, Katie. If you can just give me a second, I'm just going to stop sharing the slides, and hopefully you'll see myself and Anthony at some point on the screens. Yes, there we are. We've got everybody there now. Yeah, look, I'm delighted to welcome Anthony from Columbia Threadneedle. Anthony is the senior economist. He's been around, despite his young-looking face, for quite a long time. He really does know the investment markets inside out, and he's spoken before at our events. And what Anthony is able to do, I think, is to distill what I think we'd all term as quite complex information into a way that all of us can understand it. So I think having Anthony here is a real privilege for us today, and I'm delighted to welcome him. Rather than do a slide presentation, and you may have seen Anthony speak before, we thought this time what we would do is change the way we approach this. And we've come up with a series of questions that, in fairness, I think our clients have been asking of us about what's going on out there. And rather than bamboozle you with a load of slides, I will ask Anthony a series of questions that we thought would be interesting for you to hear. So, Anthony, if that's okay with you,
Yeah, sure.
without further ado, we did mention when we put this together that we highlighted it as the spring statement and the budget. So I know that events are very different today as they were on Monday or even Tuesday when the statement was made. But what do you think were the impacts of the Chancellor's spring statement that she made on Tuesday?
Yeah, thanks, Ian. Morning, everyone. Thank you for the compliments on my young looks below my 50th birthday, which is coming up very shortly. Yeah, I think Chancellor Rachel Reeves, I mean, it felt like a bit of a non-event, really, from a financial markets point of view and economics point of view, because I think that's exactly what the Chancellor wanted. She wants there to be one annual fiscal event, which is going to be the autumn budget, and then the spring statement becomes kind of something that is more of a maintenance type event than anything that should move markets. And I think if we think back to last November, both before and after, there was a huge focus on the UK budget, market moving event, lots of headlines. I certainly spoke and wrote a lot about it. This time around, and again, it's also been helped by other things going on in the world, it's almost been ignored by everybody, really. And I think, the Chancellor wants to move away from that sort of constant cycle of 6 months of speculation of noise about what the Chancellor is going to do next. And I think that was very much mission accomplished this time around. I think within the numbers, it's worth bearing in mind the OBR, the Office of Budget Responsibility, did downgrade the UK growth forecast. They're still not quite as pessimistic as the Bank of England, who think the UK economy is only going to grow by 0.9% this year. But and they also obviously caveated everything they said with the fact that we now have a war in the Middle East, which could have significant consequences for inflation and economic growth. But the overall messaging from the OBR wasn't that dissimilar to what we saw in November. But at the margin, even though they downgraded growth, there was some good news at the margin, which was the fiscal headroom, which is expected to be bigger than expected. And the reason for that is basically the government is spending a little bit less than we were worried about on servicing the national debt. The expectation was they'd be spending about £100 billion this year on servicing national debt, slightly less than that, only at the margin, but again, it helps a little bit. What we need to be mindful of when we think longer term, of course, is particularly as we think about what's going on in the world right now, is how much more the government's going to have to spend on defence going forwards, which is going to make all of these numbers look pretty awful once again. And to Katie's point, taxes are going higher. We're going to see taxes by the end of this decade at the highest level we've ever seen, sort of about 38%, sorry, of the whole economy. So the direction of travel on taxes is not pleasant for all of us. But I think, unfortunately, given that the government, has got their hands are tied in so many ways around welfare spending and whatever it might be, where there's no appetite to cut costs, and they have this additional spend from defence. Unfortunately, the numbers for all of us are going to get more and more painful. So as I say, in some way, really, it's kind of a non-event, but it really does buy the Chancellor, again, another 6 months before we really start focusing on the budget and what comes next.
Okay, Anthony. So in terms of the Middle East, we have to obviously mention that one. That should we be concerned, and how concerned should investors be with what's actually happening currently out in the Middle East?
Yeah, I mean, there's a good quote which was from a chap on the BBC, Jonathan Beale, who said, I think it was 4 days after the Russian invaded Ukraine, that history shows it's a lot easier to start wars than it is to end them. And I think we're in a very uncertain phase now, which obviously has consequences for financial markets, for the global economy, for inflation, and therefore for interest rates as well. There's a lot of unknowns right now. We've seen that reflected in market volatility over the first few days of this week. But again, I think it's worth reminding ourselves that financial markets are actually pretty good at looking through geopolitical shocks. And if fundamentals haven't changed, then actually financial markets can perform perfectly fine. I think the question we have right now is if fundamentals are changing. And I think, we have to ask ourselves, firstly, about the politics. And there's lots of uncertainty there. The US has kind of embarked on a war where it's not that clear what they're trying to achieve. It's not that clear how a victory as it would be defined. And it's really not that clear if there's been any planning at all for what comes next. And again, lots of questions in the thoughts on whether this is a 10-day conflict or a 4-week conflict. And there's been very mixed messages from the US in that respect. And then, of course, how this evolves from now in terms of the US has been talking in the last 24 hours about there's going to be a much larger wave of this conflict. So there are still going to be volatile moments in financial markets. The key point from our view when we look at the economy is what happens with the Strait of Hormuz, which is where 20% of all gas and about 20% of all oil supplies travel through. In theory, each day, but basically that strait has been closed ever since the weekend, and that obviously over time will have a more dramatic effect on shipping. And the reason for the closure is basically Iran has made a series of threats against shipping going through that channel. We've seen, I think, 5 or 6 ships actually attacked. And therefore, if you're sat in a very large vessel carrying oil or gas and your insurance gets cancelled, then for the moment you're just sitting waiting to see what happens next. Now, there are ways around this. We've seen it in the past, back in the 1980s, where we saw a convoys established by the US Navy and others to safely transit shipping through the Strait of Hormuz. But I think it gets more and more difficult the longer this goes on, because there's the potential for Iran to lay mines within the Gulf, which they've done before. And of course, they've got a very large stockpile of very cheap drones, which are very easy to launch, which they can fire against shipping as well. So I think we're in a phase now where we are going to see disruption to global shipping through that very important choke point. And that means, we've already seen the oil price rise. I think year to date, the oil price is up about 36%. This week, it's up 16%. And then gas prices, which we'll all find out, obviously it's got a lagged effect to the UK because of the energy price cap, but the European gas price is up 66% this week. Now, that isn't anything compared to what we saw when Russia invaded Ukraine. But long term, if we see those supplies cut off from Qatar and the Gulf to the rest of the world, that's going to cause some significant problems, both in Europe and in Asia, where they get most of the gas from. So I think short term, there's a huge amount of uncertainty. The big risk for financial markets and the global economy is sort of $100 oil. We are not there yet. We're trading at, let me have a look. $83 right now. So we're some way off that. But as I say, if we see this become more of a longer term conflict, and we see more and more disruption to shipping, and less obviously supplies getting out of the Gulf, then we are going to see oil creeping higher. What we've seen in the past, we have had episodes in the past where we've seen $100 oil. Germany causing the economic slowdown. It also has an impact on inflation. And again, if that's sustained over a period of months, we will then start to see that feed into economic growth, into expectations and interest rates, and of course, inflation itself. And the numbers estimate that it would probably put about 2 percentage points on UK inflation. So rather than getting excited about UK inflation coming back towards target, we'd be back in that period where UK inflation is double the Bank of England's targets, and we can forget about interest rate cuts. So I think in the short term, financial markets are doing quite a good job of trying to estimate that this is a fairly short-lived, intense phase to this conflict. What comes next is anybody's guess. But I think the key impact for the global economy is really what it does to energy prices. At the moment, the reaction's been relatively calm. As this goes longer, that's when we could have more problems.
All right. Okay. Well, look, if we step away from the Middle East just for a moment, and
Please.
I know it is dominating everything, but if we just stepped away, I mean, so far, 2026 has been actually very good for the markets. I mean, the Dow has breached 50,000 at one point. The S&P was on a trajectory to 7,000. The FTSE was getting towards 11,000. So really good. And when we look at our client portfolios, they've performed very well. So what's influencing? What's influenced that start, Anthony, and why?
Yeah, a very good point. I mean, if we were talking a week ago, the S&P 500 in the States and the FTSE 100, the FTSE 100 had a record high last Friday. So, we up until the shock of this week, we've been in a pretty good place. And there's a few reasons for that, really. And they're all because fundamentals are strong. Setting aside the UK economy, which is in a fairly mediocre place right now, when we look globally, the global economy is growing quite nicely. We've got lots of stimulus around that should help growth in the US, in Europe, further afield in Asia as well, in Japan as well, I should mention. And we've also got earnings. Corporate earnings have been very strong as well. So that's been very helpful. That certainly helped stock markets, as you say, to record highs. So there's been a lot of positive drivers for markets so far this year. And I did a presentation about 10 days ago, and someone asked me what's really worrying me right now. And I said, the fact that nothing's really worrying me right now concerns me in itself. And I said the biggest risk to markets remains all the concerns around geopolitics. And obviously we started the year, if you remember the first 3 weeks of the year, we bounced around between Venezuela, Greenland and Iran. And every week it felt like there was a new story really dominating the market narrative. But markets looked through that very quickly, really focused on the fundamentals. And I say the fundamentals are very, very good. Worth bearing in mind, of course, within the markets, beneath the surface of those record numbers, we are seeing different asset classes performing differently. So we started the year with lots of question marks about the AI theme. That's kind of evolved. We've seen some of the tech stocks actually underperforming, but that's been more than made up for by other parts of the market performing very well, and sort of more boring companies in many respects. So if we think of sort of the value end of the spectrum, which is normally fairly dull compared to the growth and the tech stocks, which are very exciting, the value end of the spectrum has been performing very well. And that's not just in the US, that's in the UK as well. And we've also seen a lot of markets outside of the US actually outperforming the US. And, as you'll all be aware, the United States has been the best market to be invested in over the last decade by some distance. Last year and this year so far, we've really seen that start to reverse, and other markets, Europe and Asia and some of the emerging markets, performing very strongly. For the moment, that trade seems to be on hold this week. Again, if we see these issues in Iran go away fairly quickly, I think that trend may well resume.
You touched there, Anthony, on the American economy, and you mentioned the tech stocks.
Yeah.
I think everybody probably keeps hearing a phrase called the AI bubble. I mean, what's your view of that, Anthony, and how dangerous is it or not?
Yeah.
What should we what do we need to know about the AI bubble?
Yeah, I think some history is useful here, because we probably all remember the TMT bubble in 99 and 2000. I remember working through that phase, and it felt like if you put .com on any company name at that stage, you do fantastically well. And I think we've seen a little bit of that this time around as well, with any company that can sort of attach itself to some sort of AI trend has also done very well. And I think last year we sort of saw that rising tide of AI really floating all boats. it feels like we have seen the tide turn now, and we are seeing much more differentiation between companies that are genuinely doing good things with AI and are likely to make money out of it versus those companies that are just spending a huge amount of money but actually don't seem to know where they're going with this. And there's been a big concern in the market, and the differentiation between those companies that are making significantly higher investment expenditure than the markets were expecting. And we saw that in the earnings season, like Meta, Microsoft, and Google. I think they combined, they were announcing about $660 billion of capital expenditure for this year, which is a very large amount of money and about double what the market was expecting. And that has just caused some concern that you're going to spend this much money and you don't actually have any guarantees you're actually going to make any money out of it at the other end, because you've got other places like China who are coming up with equivalent or almost equivalent products, good enough for most of us, at a fraction of the cost. So I think at the margin, we've seen a lot more questions about which companies are actually going to make money out of AI long term, and there will be plenty of winners here, versus those companies that are just burning through cash and actually coming up with inferior products. So we are going to see, I think, and it's a healthy thing, more differentiation. I think we are going to see, hopefully not a bursting of that bubble, but maybe a sort of gradual deflation of that bubble, where actually a little bit of the froth that we've seen in markets catches up with reality. So I think the focus is certainly moving on from AI. That said, I think this is a very important long-term trend, and it's going to make some companies a huge amount of money over the next decade, 20 years, but it's not going to make everyone a pile of money. And that's what we saw back in 1999 and 2000, that realization there's a lot of companies who are sort of on the bandwagon, but actually may not be the long-term winners.
Okay, and another thing you just touched on there, and Katie mentioned it as well, and I'll pick it up again. So maybe a bit of a theme today, but we mentioned multi-asset and being spread across asset classes. Why do you think multi-asset funds, and I know you're involved in them, but why do you think they're a really good way for clients to invest and have their money in these funds?
Yeah, I think it's all about diversification and not being too concentrated in one trade or one region, really. I think, we've seen this particularly in the US, where such a large part of the market is a very small number of companies. And as we've just talked about AI, if that goes out of favor, then those companies are really going to struggle, and that's a large part of your portfolio. So we think that being diversified across the globe and across different regions, asset classes, and really sort of looking at different trends is very, very important. And I think multi-asset, and certainly thinking about how we've operated this week, gives us the opportunity to be very flexible in terms of our portfolio positioning. A lot of the time when it's geopolitical shocks, the best thing to do is actually do nothing. But again, when we see the opportunities, and I think history shows, when you see the markets selling back like we saw at the start of this week, the best thing to do is, if you think fundamentals haven't changed, is actually start to put some money to work. I think in the multi-assets format, that gives us a lot of flexibility to be able to deploy cash quite quickly, but also take the view to take risk off very quickly as well, should we choose to. And again, the fact that we sit on the desk looking at these portfolios all week, and in fact all last weekend as well, really gives the scope to sort of make those decisions quite quickly. And I think obviously everyone's circumstances are different, but the fact that you're in a tax efficient wrapper as well is very, very helpful in terms of not being a reason to not trade sometimes just because things have fundamentally changed. So I think we do think that multi-asset is a very good home for a lot of clients' money because of that flexibility, and of course the fact that you've got a very strong team like ourselves really sort of looking after that money. I won't say 24/7, but it's our entire focus, as you can imagine.
Okay, look, that's really interesting. So can I just sort of sum up and just ask I think I know the answer to this, but I think it's probably worth asking is what would be your best advice you could give to our clients at the moment, Anthony, in terms of what they're thinking?
Yeah, well, I think the best thing to do when you see a dramatic point in markets is just hold fire a lot of the time. You need to sort of step back, think about every year, pretty much throughout my entire career, certainly, you get a market pullback of around about 10%. That's natural. Markets don't go up in a straight line. We always get a reason for, feeling like it's the end of the world, so to speak, from time to time. We don't think this is it. And as I said already, the market pullback that we've seen this week is not that dramatic. So I think long-term investing and staying the course and riding out the volatility you see over the short term is the best thing to do. A lot of the time, this sounds a little bit flippant, but the best thing to do is kind of ignore a lot of the noise and just let your money do the work over the long term.
Oh. Anthony, really helpful. Thank you for that. I think we
Pleasure.
could talk for hours, I know, but I think that's a real flow. I'm going to just pop the screen into a slightly back to our slides, if that's okay. So just excuse me a second while I do this, and then we can do our slides. Well, I'm hoping that everybody can see the slides. Is that okay? Can everybody see Anthony's picture?
We can see Anthony, a photo taken last
Look how
week.
young I look. So
Excellent.
yeah,
Well, it's too bad, Anthony. You've aged all right.
a lot of grey hair thanks to Donald Trump. Yeah.
Right. So what I'm going to do now is just hand back to Katie, and Katie's just going to introduce something else.
Thank you, Ian. Thank you, Anthony. Lots to think about there. Really interesting. So we're going to talk a little bit about our investment steering committee. And when we were putting the agenda together for today's briefing, it was just on the back of having finished our investment steering committee work a couple of weeks ago. And I said to Ian, well, maybe some of our clients might be interested to know exactly what we're doing here. And so we really felt it would be a good thing to just take people through what we're doing behind the scenes in Montgomery. So this is just to cover what this is all about, why we feel it's so important to our clients, who sits on the committee, and how it operates. And Ian is just going to talk about this for a little bit. So Ian, could you just tell everybody what is an investment steering committee?
Okay, thanks, Katie. Well, look, I'll kick off with this isn't what we term as an obligatory committee. It's not something that a regulated company like us must have. Many large advice firms do have one, but the smaller firms tend not to have them. However, when we set Montgomery up, we felt this was a really important function. So we've therefore created it and we've invested in it. So it's a formal governance group that sits within the business. And its prime function in terms of what it does, it's responsible for overseeing how we select, monitor, and review the investments that are used in your portfolios, our clients. So we do operate under a very strictly defined terms of reference document. We meet on a structured schedule, and we do keep very detailed records of all the decisions that we make. Our committee is also has an independent representation, which I'll talk about a bit later, that I think is quite interesting. So in short, it provides what I call professional oversight, accountability, and we're accountable for all the investment decisions that shape our clients' portfolios and keeps your investment safe with us. So that's in summary what it does.
Thank you, Ian. Why do we feel that this is so important in Montgomery?
Okay, this is, I mean, the first thing is around consistency and discipline. Investment markets are moving very frequently. Anthony's already covered that in depth. 2026, no exception. Anything that seems to be coming out of Donald Trump's mouth is moving the markets at speed. Independence Day was a good example of that, and the tariffs, and we saw what happened. The markets moved up and down. We've got the war today going on in the Middle East. The markets are moving all over the place. So you can see that this is having an impact. Having a committee structure ensures that the decisions that we make are disciplined, they're evidence-based, and they're not just reacting emotionally to some of these short-term movements and the market noise that we're hearing literally on the hour through the media. So it prevents anyone within our business, and we're only a small business, but it means that we can't make what I call ad hoc decisions by trying to pick a flavor of the month fund, something we think is in vogue, something that's doing well, chasing a bandwagon, all those kind of comments. So none of that can happen. So we're consistent. We have a discipline. Our risk management approach ensures that we are keeping up to date, I'm sorry, with the market conditions, what's happening economically, what the portfolio risks are, so that we can ensure that all of those investments are aligned to their intended objectives and their risk profiles. So, for example, every single fund that is on our panel is rated by Defaqto, and it will therefore align to each and everybody's own personal risk profile. So that's really important for us.
Thanks, Ian. Just thinking about the reasons why we have our steering committee, because you did mention at the beginning that it's not an obligation. We don't have to do
No.
it. You know, what are the alternatives? What would we be doing? How would we be selecting funds if we didn't do it like this?
Yeah, good question. I think we'd end up in a bit of a scattergun approach, quite frankly. I think we'd end up, we would try and pick funds, and we would try and work out what the flavor of the month was, what the best fund was. We'd have individual preferences. You, me, Tracy, our independent representation. We'd all have our own preferences. We'd all think, oh, that fund's great because we knew that fund manager, etc. We wouldn't have that level of consistency, and I think we'd also judge things differently. Well, you might, for example, flavor something that has performed very well over a 12-month, 2-year period. I might be saying, hang on, let's look 4, 5, 10 years at funds. So we wouldn't have consistency. We would be, I fear it would not be a great thing to do. And I wouldn't be comfortable that our clients' investments were being managed in that controlled way. So that's why I think having this is important. So around sort of due diligence, every single fund that we have recommended on our panel goes through a very detailed, structured research and approval process. We use our own Montgomery Core Fund filter system, which we've developed, that sets the criteria for the funds being on our panel. Now, the fund universe is circa in the UK around about 11,000 funds you can choose from, and our panel only has 70 funds on it across all of our risk profiles. So we have a range of filters. So they've got to be either multi-asset or multi-manager funds. They have to be risk targeted. They have to have a risk profile associated that we can map to de facto. They have to have a minimum of £50 million invested. They have to have a minimum of a 5-year track period. There's a whole range of filters that we have that allows us to filter and filter and filter down to that very small tight panel of 70 funds. And that protects people by having the right investments, that they are appropriate investments that now sit on our panel. They're competitive. We look at the prices of these funds as well. That's really important because that can affect long-term returns, and they're regularly reviewed. So it's only by having that limited number of funds as well that enables us to build good relationships with fund managers. And I think today's an absolutely classic example of that, where we're really lucky to have Anthony from Columbia Threadneedle come and talk to our clients directly, so that they're hearing it from the guys who are running the money, so to speak, So I think that's a real benefit for us as well. So accountability is important, that no one can make any decisions individually. They're always made collectively. We debate things healthily. We document everything. We agree collectively. We have a range of skills and experience. And we use that strictly defined criteria along with our investment beliefs. And for our clients who are today, if they want to see our beliefs, you can visit them, and they're on the website. They're on our own website. So we actually make sure that we map everything to our investment beliefs as well. So ultimately, the committee is there to safeguard our clients' interests, and it strengthens the quality of the advice, Katie, that you also then provide to our clients. So for me, it's really, really important for our clients, and something I'm, as you know, very passionate about.
Thank you, Ian. So, Ian, can you confirm who actually sits on our committee?
Right. There's only 4 of us. It's a small committee. It's the 3 of us within the business. But one of the things we decided to do very early doors when we set it up was to actually bring on some independent representation, because we feel that's really, really important. And we're lucky to have a gentleman called Luke Tribe, who's head of research at our compliance consultants, 360 Services. So Luke is an invited guest at every single meeting that we have. He's highly experienced in the world of investments. He's an expert. He brings us a wealth of knowledge and insight that we just don't have ourselves on certain things, and insight into the discussions and any decision-making process that we have. I think having somebody independent on the committee also ensures that all of our decisions, everything we do and everything we say, is validated and always in our client's best interest. Nothing else counts as far as this is concerned. So for me, having that independent representation, not something we need to do. It costs us money to do it, but I think it's money well spent and helps our clients.
Yeah, absolutely right. Okay, in just a few minutes, can you tell us how does this operate?
Yeah, structured meetings every 6 months, more frequently if we need them. All of our research is structured. We look at fund performance. We look at a range of other risk metrics. We look at some qualitative data as well. We don't just look at performance over short term. We tend to look at it a bit more in the long term. We look at volatility of funds. That's how they're moving upwards and downwards. And we also use other metrics now, such as Sharpe ratios, which I won't go into, but that actually looks at the way the risk versus the reward for each fund. So we use a range of metrics. We use very sophisticated software from Defaqto Engage, so we can see every single fund out there, what our panel looks like. We have very good data from 360 Services, from their DD Hub system, which is their fund system. We use other proprietary software from RSMR, TrustNet, etc. So massive amount of data that we use so that we can see exactly what's happening to these funds. In terms of the managers and fund reviews, we look at those in detail, and that's when we're assessing whether the managers continue to meet the standards that we've set. We meet with them, we listen to them, they make regular comments, and they do podcasts, they do videos, we listen to what they say. If we're concerned with anything, we can get access to them and speak to them. We use fund review reports from Defaqto. They produce independent reports on each fund that we look at as well. So massive amount of data that we sift through and we work through. All of our decisions are well documented. Everything's got a rationale about why we do it. We've also got a very small list of what we call watch funds, where there may be circumstances that we think it's right to keep a close watch on that fund. Isn't always performance related. It could be there's a corporate action, they could be changing the asset allocation, could be changing the investment philosophy, maybe moving a risk profile, maybe something around charges, etc. A whole vast array of reasons, but again, fortunately, that's not something that we have to utilize a lot. So if we need to make any changes to the panel, so if we need to replace a fund, all of these decisions are made in a very implemented in a controlled and transparent way with clients. All of our data is very, very well structured so that we can identify exactly what clients the funds invested in. So if we needed to make any change, Tracy can do that very quickly, very easily by the press of a button on Transact. So far, I'm pleased to say we've never had to do it, but we could do if need be. Fortunately, we've only made a very few small, what I would call tweaks to our panel over the last 4 years, which I think is a real sort of testament to the core fund filter system that we have built and managed, and also the role of the investment steering committee. So what I'm going to do very quickly, because I am conscious of time, is I'm going to canter through at pace, but I'm going to try and bring all this together and show you what a typical an example 5 to 6 portfolio would look like. And here you'll see I've chosen 4 funds off our panel. And we've put the money equally, 25% into each fund. 2 of those are what we term as active funds. That's the top one, the Aberdeen Fund, and the Orbis Fund at the bottom. The other 2, the CT Universal MAP and the Liontrust Dynamic, are passive funds. Underneath that, you can see that is where the assets are allocated. So you can see there's a fairly high weighting there into the States. There's money in Europe, there's money in emerging markets, there's money globally, there's Japan, there's in corporate bonds. That picks up what Anthony was saying about multi-asset funds. So there's a fund with a load of different assets sitting in different places. So if I then show you the performance of those funds, the cumulative performance over a period of time, you can see all of them have to have a 5-year track record, and all of them have performed well over that 5-year period. The CT fund doesn't have the MAP fund doesn't have a 10-year track record as yet, but all the others do. And again, you can see, for example, how well those have performed. The global fund, Orbis Global Fund, has done particularly well for our clients. And if I combined all that together, then the chart below shows how that total portfolio has performed over that 5-year period. And you can see it's an upward trajectory. So Last but not least, again, I wanted to show you the top 10 holdings in that portfolio. And again, I make no excuse for saying using the word multi-asset. This is where multi-asset funds come into their own. The fund managers are not just constrained to picking funds in their own fund houses. They can pick funds across that whole universe. And you'll see that with a range of different funds that are sitting within that portfolio. This is the best way to access the best funds in the marketplace. I'm picking up on what Anthony said. If you're invested in a general insurance account, for example, so you're not in a tax efficient wrapper, there's no selling responsibilities and buying, which causes CGT issues for our clients. So this is really the best way to invest, and something we feel very strongly about, and so far has performed incredibly well for our clients and continues to perform well. So I'm sorry if I've canted that quickly and I've spoken quite quickly, but I thought it was important to show you that. And I think it's now time for me to hand back to Katie. Oh, sorry, I'm going to jump through that slide. There you go.
Lovely. Thank you, Ian. Okay, so as far as takeaways from today are concerned and action points, I think what we're really saying is don't put off planning. If something needs to be looked at and reviewed, then let's do it. We always feel that reviewing wills and trusts is a very good place to start. Making sure that we have up-to-date inheritance tax calculations done, particularly keeping in mind what's coming down the road next April with pension funds being included in the value of the estate. Reviewing investment portfolios again, I think it's quite clear we're passionate about multi-asset funds here. So if they're not in multi-asset funds, good idea to have a look. If you want any information about capital investment bonds, whole of life insurance, gifting strategies, anything that we've talked about today, we do have handouts, so please do ask us for those, and we're very happy to send them. And we're here for any advice and help in Montgomery and legacy protection. And I think that's us for today. Thank you, everybody, for joining us. We look forward to seeing you all again soon.
Thank you, everybody.
Thanks.